To meet its expenditure needs, the government resorts to borrowing. In India, this is done by issuing government securities known as G-Secs and treasury bills known as T-bills. These borrowed funds are categorized under capital receipts in the budget document. While the Department of Expenditure under the Ministry of Finance handles the borrowing program, it is finalized by the Government of India in consultation with the Reserve Bank of India. The need for government borrowing arises when the revenue generated from taxes and other sources falls short of covering the expenses outlined in the government's budget. That is why the government announces an annual borrowing program in its budget to bridge this fiscal gap. The central government follows a semi-annual borrowing calendar, while states follow quarterly calendars. The first half of the centre's yearly borrowing plan is announced with the union budget, while the second half may commence in late September or early October. The government relies on various sources for borrowing. This includes market borrowing, small savings fund, state provident funds, external assistance, and short-term borrowings. Market borrowing is the primary source of financing the fiscal deficit. Under market borrowing, the government also issues special securities to entities like oil marketing companies, fertilizer companies, and the Food Corporation of India. These are often referred to as oil bonds, fertilizer bonds, and food bonds. These securities serve as compensation to these entities in place of cash subsidies and are typically long dated with slightly higher coupons than regular securities. While they do not qualify as statutory liquidity ratio securities, they are eligible as collateral for market repo transactions. Government borrowing can impact the economy. Firstly, when the government borrows extensively from the market, it leaves limited space for private sector entities and corporations to access the market for their financing needs. This can crowd out private investment. Secondly, substantial government borrowing can lead to increased interest rates across the board. This in turn raises the debt repayment burden of the government and drives up the cost of borrowing for other entities. High interest rates can also hamper economic growth by discouraging investment.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.
She has ambitions of becoming a brand. Business Standard.